And joining me now on Business Tonight is Andrew Canter, Chief Investment Officer of Futuregrowth Asset Management. He's in our Cape Town studios. Good evening to you, Andrew. Good to see you, as it were, again on the video monitor, at least in Johannesburg. Bond indices, you're against them. You've used some strong language about it. What's different here? We use market indices generally. It's kind of accepted as part of the investment discourse. Explain your view here.
So we all get used to, in the investment world, using market indices as kind of a benchmark for performance, for taking risks. You hear about the massive move towards passive investing using indices, and that comes very much from the equity world. I mean, an equity index over time replicates the economy, doesn't it? Eventually, all companies grow up and all of them become listed on an exchange. And that's fine. You get a broad sweep of the economy, you get diversity, you get true representativity. When you think about the bond indices, and if you use cap-weighted indices, who ends up in bond indices? People that borrow too much money. And not every company borrows money, and not every company borrows money on the bond market. As a consequence, you end up with highly concentrated, non-representative indices, and people who passively try to match those indices, particularly credit indices are my concern, they end up holding big overweight positions in the companies that have far too much debt. And you could see the flaw there. I mean, you could bet that Enron, for example, or Parmalat were the biggest components of the credit indices before they blew up in flames in the early 2000s. So you see the problem. We don't want to drive down this road of blindly following indices.
Well, it sounds like you're indicating that there's a problem waiting to happen here and something needs to be done about it.
Well, okay, so the good thing is this. Look, the JSE All Bond Index, as constructed, is basically today a government bond index. That's good. What is it that makes a good index? Well, it's replicable. That means you can buy it. It's liquid. It's representative. It represents the market. It's relevant. In the case of the All Bond Index, it's a long-duration, fixed-rate benchmark suitable for pension funds and suitable for the government issuer. All right? It can't be manipulated. Now, when I think about that index, it's actually quite a good index relative to global bond indices. When I think about credit indices, and there is a push in this country by some parties to have credit indices. Oh, we need things we can match credit managers against, and da-da-da-da. It's a fool's errand. It's a dangerous thing because you're going to end up with people passively buying bonds, and you're going to end up with rubbish portfolios. So the JSE's constructed some of these indices, and they've made a good effort. They've done a good technical job. But for example, their 30 fixed rate bond index, the top 30 fixed rate bonds, has I think a weighting of like 70% to the banking sector. 70%? Yep. Is that replicable? Is that suitable? Is that a good index? The answer is no. It's a horrible index. It shouldn't be used.
Are you alone in this? Are there other voices? And have you made representations about this?
Sure. So through ACISA and through the ACISA Bond Committee, we do speak to JSE. The voice has been heard. This is not something the JSE is pushing hard for. I'm more concerned that there are some parties out there who are trying to use these indices as a benchmark for managers to match. There's people who believe they can buy a passive bond fund and save a few basis points on fee and get a cheaper product. Well, they will get a cheaper product, but they'll end up losing money in the end because they'll end up with portfolios that have defaults. I mean, Able was a big component of the bond index, and it went bust, for example.
Yep. Is a phrase that you've used. Passive credit investing is like a passive walk in the Kruger Park. In the end, you get eaten.
Well, exactly. So let's think about the credit market itself. Who brings bonds to the credit market? These are usually sold by banks who sell them to institutional investors because the banks don't want these things on their balance sheet. They're weak on terms, they're weak on conditions, they're weak on covenants, they're weak on security. They often have terms, legal terms that are very, very borrower-friendly rather than lender-friendly. So for example, what we know globally is when companies get into financial difficulties, they go into default, bank loans have a much higher recovery rate than bonds issued in the capital markets. Why is that? Because institutional investors aren't very good at negotiating debt. They buy bonds like they buy underwear. You know, they're off the shelf without thinking about it a lot. So when I say that, a passive bond index, we just buy whatever's sold to you, is a very dangerous thing. As I say, there is no such thing actually as passive bond or passive credit investing. You have to actually pay attention to who you're lending money to. And I mean, do you need me to tell you that? Common sense says if you're going to lend somebody money, you bloody well pay attention to who you're lending money to. You do financial analysis, you do ESG analysis, you do sector analysis before you make that loan. That's just sensible, right?
That's right. Well, that's what people are there for, earning fees. Final comment, Andrew, before you go. I think you've wrapped that one up nicely. Just more broadly, the economy generally, the equity markets generally, what's on your mind at the moment?
Interesting. I was just watching the oil price ticker by, and it's looking quite weak, down at $41 a barrel, and that's before the equity market really starts going down, and that belies my view. I think developed market equities are in a risky territory. I think people say, oh well, one Fed rate hike in December doesn't matter. They are missing the fact that the 2-year and 5-year bond yields in the U.S. have spiked because the Fed ain't going to raise rates once. They're going to raise rates in a series of sequential steps up to 2% in the next 24 months. I mean, and the market is not discounting that. So, you know, in a strong dollar, weak earnings environment with a rising discount rate, I can't see how global equities do good in that environment. And now, frankly, I'm a bonds guy, so you must take this with a big shaker of salt, but that's what I'm thinking about. So talk to me about buying oil at $35 a barrel in WTI. Talk to me about buying equities 15% lower than they are today.
That's Andrew Canter, as usual. A lot of value in a short space. He is the Chief Investment Officer of Futuregrowth Asset Management. Thanks for joining me, Andrew.